Welcome to another episode of Real Estate Investing Explained. Here's today's question. So what exactly does it mean to identify a property? What is that process? Who do you have to tell? Is there paperwork? What does that look like?
Statute and regulations give you a couple options, but typically you would identify with us as the qualified intermediary. So what we do is you close on Monday. On Tuesday, you get a letter from us saying, "Dear taxpayer, we have your money and here's a form to fill out." And they have to then just complete that form. They should include as much detail as is reasonably practicable. That's from the statute at the time of the identification. So that means a street address with including city or state. It means if you don't have a street address, if it's vacant land, you would want to have some sort of meets and bounds description or a tax map or parcel number. If you're buying a percentage interest, if you're buying a tenant in common interest or something called Delaware statutory trust, you would want to indicate what percentage you were buying as well.
So what happens if you're in this period, you identify those three properties, then you're not able to purchase any of those properties? Are you able to identify additional properties after that?
Yes, so unfortunately, that 45-day period is really strict. So if you are not able to either identify the properties or you're not able to purchase those properties, the exchange disallowed, and then the investor gets the funds back, and they would be liable in tax.
Is it common for investors to not be able to meet that deadline? I know you deal with a lot of 1031 exchanges, so how common is it for somebody to meet that deadline versus somebody not? And I'm especially curious because of where we are right now in the market cycle. I think a lot of markets in the US are very competitive right now, so it might be hard to find a good deal that's actually worth putting your money into. I think Michael mentioned earlier in the show, you don't want to just dump your money into a deal to take advantage of a 1031 exchange because you'll lose more on that bad property than you'll save in taxes on the 1031 exchange. So it can be difficult to find a property that's worth buying within such a short period of time. So I'm curious to hear how many people are actually successful at that versus how many people actually have a hard time.
So the majority of our clients are successful. It's hard to tell you percentages. I would say maybe 20% of our clients, or maybe they do and the deal fails and they are not able to close in 180 days. But the large majority of our clients do complete the process and buy replacement property. There are some options. So that's why you have three properties that you can identify. It gives you options in case one deal falls through, but it's not fail safe. And the most important thing maybe to get out of this talk today is that if you're planning to do a 1031 exchange, you want to start shopping either before or at the same time you were trying to sell your property. Because like you said, we're in a kind of competitive market in most of the good areas of the country. It may be hard to find a property that makes sense. So you want to start shopping and doing your homework right away.
Now, there are two unique scenarios that we will also mention that you can look at strategies to make sure that you work in that timeline. There's DST, which is Delaware Statutory Trust, which is essentially what I like to example is that when I was applying to college a very long time ago, you basically have certain safety schools, right? So these are options that are great schools. But you know pretty certainly you'll get in there, and there's some home runs that you're looking at potentially getting, potentially not. So Delaware Statutory Trust, Mike, can you speak a little bit about it and why it's a safer option that you can make sure to come into?
Delaware statutory trust, basically you're buying fractional ownership in a property with a bunch of other people. Typically, these are run by funds. So you may have a REIT, may have a subsidiary that sells Delaware statutory trust. And so what they do is they buy a property in a land trust, typically formed under Delaware law. And then they sell off beneficial interest in the trust to 1031 exchange investors. And under a revenue ruling that came out in 2004-86, says that that's like kind to the real property that they sold. Even though you're buying a trust interest, it's really a property. It's very similar to a tenant in common interest, which is maybe more, something people are more familiar with. But this is the structure they use on an institutional level. And the benefits of a Delaware statutory trust is that you have certainty of closure. So, they're not going to go away. If you put a reservation in on day one after you're closing, they will close with you, provided you meet certain thresholds. You have to be an accredited investor, and there's some other, loopholes to jump through. But once you identify it, it will close. You don't have to worry about it disappearing. These are, as Alex said, they're safety investments. Some people will buy them because they're sick of the 3 T's, right? The tenants, the trash, and the toilets. And they'll buy this passive investment that somebody else manages. But also it's a good backup for a 1031 exchange, or it's a good gap filler. So if you sold for $1 million and you found the property that you love, but it's only $700,000, well, you have to fill that gap of $300,000, and then you might buy a second property and do that in the Delaware statute. That's an option. We have people doing that quite often.
The other option is actually called a reverse exchange, which is you may have a property that you really that you really love and you want to make sure it doesn't get bought up. There's such a hot market. So what you can actually do is you can set up what's called an EAT, and what that would allow is essentially you lend money to the QI who would purchase that property on your behalf, and then once you sell, and then you would sell your property you own within a 180-day period, and purchase using the funds from the sale, purchase the property from the QI. Mike, you want to clarify a little bit?
So a reverse exchange is useful in that it allows you to buy before you sell. So you may know that it's such a hot market that you're not going to have any problem selling your property, but you might have trouble finding a property. So what you do is you go out and you find the property first, and then you list your property. But that, as a result, you might have to close on your purchase before your sale. And so what happens is you basically are parking title to the property you're purchasing. We become the buyer. You loan us the money. You and your bank loan us the money. We buy it. We take title to it. We hold title until you sell your property. And when you sell your property, you're essentially buying the property from us, sales proceeds. And then we take the sales proceeds we receive and we repay the funds you advanced to buy the property. So that's called a reverse exchange. And that's also a useful tool that many of our more sophisticated clients use pretty regularly.
That's all for this episode of Real Estate Investing Explained. Be sure to follow me on Instagram, Twitter, and Facebook, or subscribe to our YouTube channel to get even more free content.